NASDAQ closes at all-time highs on the weekly. A hot CPI was completely shrugged off on Wednesday, and we did nothing but rip. We're going to explain why. And it's not what you think. We're going to cover why some are absolutely great dip buying opportunities, why others are not. What the SPX breath is telling us about the market and why you should pay attention. Commodities are breaking out and why that's actually a good thing. We have a ton to go over. Let's get to it. Welcome back, everybody. What a week. I just want to point out that still 25.5% of you do not subscribe to this channel, which is baffling to me. If you watch these videos, they're all connected. Simply click the link. I don't run ads on purpose, and by subscribing, it actually helps me get the message out there and it helps me avoid running ads. So in the middle of this, because the algorithm loves their ads. All right, let's get to it. And I think that there's a lot really to cover here. We're going to start talking about Wednesday and what happened with CPI. And I just think it's really important to point out this is the 55, this is the 22. And we went over this pre-market live. And even if you can't attend the pre-market lives, you might want to just watch them later. They're all recorded. We leave them up on purpose. And the people that watched look like these guys and not these guys. All right, last one, I promise. Go Birds. So if you see how this happened and then you just kind of did the shakeout, you actually did your retest, and then you just watch the top of this bar. One thing that we always preach here is marking off that 830 bar. And the reason for that is pretty simple. If you did that, you had a pretty good day, because all you had to do on Wednesday was just mark off that level and just realize that you never really broke it. You actually came back, tested, retested, tested, retested the same level that 1 minute. And then that was pretty much it. It is absolutely crazy how that works, and that still people that watch these videos don't mark off these levels. Specifically, what you want to do, and I want to drill into this, there's 4 areas to always mark off on these bars. You always mark the high, the open, the low, and the close. So the high, the open, whether it's green or red, doesn't matter. The close and then the low. Just mark them all off. You'll get 4 levels. It's more like a band up here. That's how I would refer to it. And you'll see how you test it comes into that. But this is where the algorithms and high frequency traders are literally telling you, we'll buy everything you have. So when it fails there, you know, all right, I better stay out of the way, because even the high frequency traders and the algos, they can't even stop the bleeding. So they're wrong. So I better stay out of the way, because I can't stop the water. So then you look up here and you go, okay, well, that's where someone said, I will sell every single thing you have, all the algos and high frequency traders. So when you get to those levels, you know you have something of significance. And it doesn't matter if it's a day or not a day, but when you get near them and you start doing this, you're getting Matumboed. You don't want to get Matumboed. So then you just watch those levels later and you can see the test, the fail, the retest. And that's what you're looking for, the backfill on those levels over and over and over again. So when they're marked off and you're watching something like this after PPI at like 1:30 on a Thursday and you hit it and you bounce, well, now you know why you held those levels, and then you can kind of go from there and see how the rest of the week played out. You had weak retail sales. Guys, we're going to go through a lot of macro data today and actually explain to you why it's possible that CPI may have actually peaked, and a lot of people are not going to believe this, and that's great. Just comment below and I can get into why you're wrong. So please take a look at the data. You're going to want to spend some time on it. There are parts of this video you might want to watch a couple times. See how this is getting tighter and tighter and tighter in here, and tighter and tighter? It's telling you what's happening. It's just up to you whether or not you want to listen to it. If you zoom out on this on the 4 hour and we do the simplest of things and just click this button and get rid of everything, you will see a 2255 cross right here. Now you're seeing the 2255 cross right here, and you're seeing test after test. Just putting in that bottom. You can see the failed H right here. You can see the rally over. You can see us over that critical level on Friday the 7th. And now we're all the way back to here from January. But wait, there's more. Everyone remembers Itchy's special level and how he's just completely rejected us right here. And that is obviously from December 18th, the FOMC. And you're still battling it, guys. It's not over. Nothing is over, right? You can still see it right in here. Isn't that cool? You add that line and then the other lines just pop right in. So if you ever want to get off of this real quick, you just click another line and it just pops everything right back for you. And then all you have to do is just hit it again. Isn't that crazy? But anyway, from that level on, you can just kind of see how that's going. And I do think that's important. I do think that's a level that you must watch and go from there. Take a look at the NASDAQ. It actually looks better, and that's very telling. In front of us is a 4-hour chart. And why is this important? You're looking at the NASDAQ right now, the NQ. And one of the things I've been hammering home, you guys are probably sick of me saying this, is the 21.5 over and over again. I look for points of confluence. What that means is areas where there's a lot going on. And what do you have going on here? You've got the peak VWAP that's in that area. You have the election VWAP that's in that area, hope, change, everything, blah, blah, blah. Itchy's FOMC December meeting on the 18th. This is where he stopped talking and everybody was like, thank God it's over. And then you can see us test, the retest, the failure is what you're looking for. And when did that happen? Oh, look, it happened on CPI. So the same level over and over again now gets named not only Itchy, but now that's that CPI level, the election VWAP, the peak VWAP, the 22 and the 55. If you want to know what you want to hold and never break, 21, please don't break that. It's very clear. The test, the retest, over and over and over again, you've held it ad nauseum. Now you're over the top of the H, and that's really important because you have the H here from Itchy speech. You rally it up, you mark it off, can't get over, can't get over. What did you do? Test, retest, forms a hammer, flips the hammer, get the confirm. All into a Friday rally. Now, why is this important? Have we been rallying on Friday? Say it with me. No, Fridays have been a dumpster fire floating down the river, right? We all know this. I mean, here's a Friday right here. They're not fun. They have not been fun. I've had fun before. It doesn't look like this. So when they're dropping like this, even these areas, you just want to look at them and go, okay, well, what day are they? You mark them off. Remember, Fridays are the days that guys get out of the market. They get out. Why are they getting out those days? Because that's when the pension funds look at their portfolio and go, we're long too much equity. We were supposed to sell XYZ this week. That's why Fridays are so important. Now, the other thing that Fridays have had, and these effects on Fridays, have really just been Trump and his tariff craze. You know, we're gonna really do tariffs. We're gonna go crazy with the tariffs. I really mean it. We're gonna go crazy. No, we're really gonna go crazy. Everyone's at this point, you can just see the level. So if I click off of this and you just measured from here down every Friday, what are you seeing? It's actually gotten to the point where you guys are, even when you watch me play around with technology, it's like, whatever, boomer. Like, we don't care anymore, right? And now you're getting to the point where it's now flipped, that you're buying on Fridays after massive selling, major selling, minor selling. It's now flipped to what? Now we're just buying because we know, we get it, tariffs. But there's more going on under the hood, and let's take a look at that. Now we're going to break this down in sectors, and I'm just going to repeat this again. I'm going to show a private video at the end of this, and if you're in the community, you saw this a couple weeks ago. I want to show you why, because you have to start understanding the theme. So for those that watch this video in its entirety, I'm just going to save you time. There's also a video at the end of this, but when you watch the methodology that I explained to you in this video and you're like, he's off his rocker, go and take a look at what I said 3 weeks ago. And you can go and take a look. If you've watched that video already, you don't have to watch it if you're in the, obviously, you don't have to watch it at all. But if you're in the community, you've already saw it because it went out as like a private emergency video. But anyway, I want to show you that so you can understand the theme and the process and how this works. But if you take a look at what's happening here, technically speaking, you guys know I love when I pull at the stool, but we're going to get technical and then we're going to get into it. I think it's really important to understand what you're looking at. The 200, the 50, the 20, and the 5. These are percentages of stocks and where they are above their respective moving averages, above the 5, 20, 50, 200. You guys get it. You've seen this before. And I don't want to spend a lot of time on that, but there are important levels here. Long term, always want to be above the 50. Medium, intermediate term, above the 50. A matter of fact, institutions will literally stop buying equities if this breaks the 50. If I go through my institutional research, there's nothing more than people point out than when this breaks that 50 and when it gets back over that 50. You want to see when you became like really bad at trading? It's when this broke 50. You want to see when you got good at trading again? It's when it's above 50. This breaks below 50, don't be a dip buyer. This breaks back above 50, maybe be a dip buyer. Okay, just if you thought about it that way, you'd save a ton of money. Now, under here, as we're lifting here and as this is lifting, what do you note here that's really significant? So when we were up before in this area on the 200 and on the 50, the 20 was all the way up here to get to this level. Look where the 20 is now. You're back to a 47. Look where you are on the 5. Now, I'm going to explain the significance of this so that you can get it. You're not overbought on the short term at all on any indication here whatsoever. Not at all. As a matter of fact, it's the exact opposite. You actually have room on the short term to run before you got overextended again. See, if you time these by the 5 getting up to the 90, you can always find these areas of interest where you could say, okay, well, we might be getting toppy here. And it doesn't mean that you are, but there's an argument to be made that, oh, we're getting toppy here? Yeah, I could see how you can get toppy in here. This is at 75. This one's at, 70, but peak is really 90. You're at 80 here. You can only get so many over. But when you see this, and like even here, when you're down and everything's down below those 50 levels and you spike, you know it's going to be short-lived. It took you right in the itchy's level, and then you got Matumboed, right? All this breath is telling you that this is what's happening. Even here when you made what? The lower low, even though this went higher, it didn't matter this was a lower low because the breadth increased. And this is really important to get. See how these lines are just flatlining? That's exactly what you want. Flatlining and slow increases. Flatlining and slow increases. Declining, totally okay. It's totally fine. People will say, well, that means that this is going to happen. No, it doesn't mean that at all. It means what's happening is you're rotating. And that rotation on the short term is leading to that. Meaning, look at the 5. The 5's not breaking. Okay? And so when you look at these, that's how I would look at them. And I would tell you right now, the breadth looks excellent. It's probably one of the best readings on breadth that we've had. Not obviously of the year, it hands down is. But probably in the past 12 months, if you were to look at the breadth and say, like, is this pretty clear what's going on? Yeah, I mean, you're flatlining here and you're setting up. It's kind of reminds me a little bit, if you go back and look at these environments and say, could you find another area where you flatlined? If you went back to the beginning of 24, see the flat line in here? You're doing the same exact thing. You're actually doing it in here too. That was a really good time to start looking at equities. And this is a very different market over the past week and two where it started doing this. And now you're through CPI, and we're going to dive into that in great detail. Now, for those that have been following on Saturdays for some time, and if you haven't, I would suggest that you start following this channel, especially with what's coming, because you're going to start seeing some pretty significant moves here as people start to understand that they may have missed something. And I think that's where this is going. So let me explain this. You have a stool. We all know the stool. If you've been watching for some time, you have the macro side of the trade, you have the fundamental side of the trade, and you have the technical side of the trade. And then on top of that, you just have where we sit. And these 3 components make up the stool, and it's how I trade. Sometimes you're leaning on the front leg and all the macro stuff is really important. Other times it doesn't matter and you're on the back and you're on the technical leg. I would also just suggest that just basic understanding of this, if you're in a position where you're doing more day trading, you're really always leaning on the technical leg and what's happening, right? The more you're leaning on your back foot when you're technically trading, and the more that you go into, oh, I want a swing trade or I want a long-term trade, that is really leaning you into here. And just understand that when you look at something like this, it's really important to get that. These are my little marks so that you get it. And the more that you're scalping, et cetera, you zero-dated options, you crazy kids, you get it, right? So you're leaning on the technical side. It's important to get that. But understanding what is happening is clutch, because if you got this in the end of 22, you did exceptionally well. So I'm just going to ask you to look at this with an open eye and just keep in mind what I'm saying. You don't have to agree with it. A lot of people don't. It's why I like the comments. It always helps me think. I'd rather have somebody have a solid argument to what I'm saying so it can show me where I'm wrong. But I found this really interesting, and I'm going to share some research with you today. UPS. Okay, so right here, UBS, and this is actually Poland that they're discussing. But I just want to point out something when I'm going through all this research, which I do during the week. Here are their targets. So if I look at their targets, one thing stood out to me on this chart. Well, from 24 to 25, what are they saying here? Let's clean all this off so that we can really dive into it and get into the nitty gritty. Here's the dollar. And so what are they saying? And this came out roughly from the time of recording this, maybe a day ago. So the CPI was out. They're saying CPI is going to drop. Well, you just got a hot print and they didn't change it. They're saying that the yield's going to come down and they just got a hot print. So they're suggesting that the hot print is the hot print. What I'm thinking is that we peaked, and there's some signs of this. And I think that that's where this is going. Now, the hard thing about these turns is that we don't have access to the data, meaning you have CPI, for example, and you have all these sections in CPI, right? You have the food, you have how that data comes in, you have the energy, how that data comes in, the OER, which is the owner's equivalent rent. We don't have access to all this. You could sit around and do it, but you don't have 20 economists that are working for you. So this is when fundamental research really comes in handy, because you're looking at what they're coming up with and going, well, the print was hot. Well, like, why aren't you adjusting your numbers? And they're not. A matter of fact, as you're going to see, they actually took PCE coming out. They actually took it down. Some of these I'm just going to rip from the headlines because it'll just save a lot of time. But in their derivatives department, there was a statement that despite the hot print, weaker retail sales, the volatility has continued to be relatively tame. Go look at the VIX. It's not moving. Now, when we sit here and look at just the basics, what they did here, and this is just from Goldman, but what they did here, which was fascinating, PPI consumption proved incredibly benign in the context of core PCE. Remember, when PCE is calculated, just like CPI, the pieces come from PPI. And this is what I'm saying. We're not going to sit around and take the pieces and components of PPI and then correlate that out to PCE. We're just not going to do it. I mean, you might do that in your free time. I'm not going to. So a hotter CPI reading. Core retail sales declined. So you have a hot CPI, but the PPI showed that the context of PCE drove the reversal in rates. Core retail declined 0.8 in January against expectations for a moderate increase. Import prices also softer side. So if import prices are dropping, how long can the CPI go up? See, import prices are a leading indicator of CPI. We also estimate that the core PCE price rose 0.29 versus our estimate of 0.3. In today's import prices report, why? Import prices are a leading indicator versus CPI, which is a lagging indicator. Corresponding to year-over-year rate of 258. So with this hot CPI that's all over the tape that everyone was telling us that is the worst thing in the world, they're dropping their PCE number. And people say, well, it's only 1 point. It's direction. All we're looking for is direction. And I do agree with this statement. Again, this was from another firm, but where's the volatility? Where's the beef? No one's buying VIX calls. I mean, people are talking about it, but no one's doing it. And in these lines, when I read all this research, what's always just so fascinating to me is when you just see some of this stuff in. Hot CPI followed by a mixed PPI rating that contains softer components than first appeared, as well as weaker than expected import prices. They're hammering this home again and again. And they're saying PPI above expectations, but the details revising core down. So after all this data that you've gotten from CPI and PPI, they're revising PCE down. Along the way this week, we saw Treasury yields spike up 10 basis points only to then rally 18 basis points. So what is that telling you they're doing with their money? And people are trying to figure out why the market went up. What are they doing with their money? They're buying bonds on the back of a hot CPI. And I just want to reiterate this. If you listen to Jerome Powell's speech, which you may or may not have listened to, yes, the Fed targets PCE. This was in Morgan's report. It's almost as if they're saying, we understand CPI, but everyone's saying, just wait for PCE, wait for PCE. I think that this PCE report is probably, when this comes out, it's probably going to be one of those moments where we all go, oh, okay, I get it. That's my opinion. Now, even Morgan Stanley, that was trying to be pretty negative on some of this, and they just ripped the Band-Aid off. They're like, core CPI surged by 0.446 compared to consensus expectations of a 0.3 print. Okay, and then they come up with this other report. But here's where it got interesting to me. We're tracking a more modest 0.29 as the core PCE, since PPI components that feeded the PCE were soft. So they're reporting the same exact thing we just saw from Goldman. And why this is important is, but you're telling everybody to, all is well, don't panic here. But wow, this came in like 50% higher. Well, why are you lowering a PCE? This is where the devil's in the details. Now, Bank of America tends to focus on this other indicator, which is pretty interesting. Ex-volatile inflation, which was up 0.6 from 0.0. Previously, 3-month average was 0.3 versus 0.3 before that. Core X food and energy was up 0.8 from -1 in the last 12 months. X volatiles was 0.42, down from 4.3. Inflation X volatiles was 4.2 versus 4.3. Core X food energy was 4.1. Okay, what does all this mean? I want you to just pay attention to one thing. In the last 12 months, inflation X volatiles was 4.2 versus down from 4.3. Just pay attention to that for a second. Now, what Bank of America does is they break out core, which is food and energy, and then they also have another section that they refer to as X volatiles. And a lot of people don't do this. I want you to think of this taking out all food, all energy, and this taking out fuel and fruits and vegetables. If you think about it like that, it will make a lot more sense. What I really want to point out here is the headline CPI and how that's going higher. And then what are we starting to see here starting to happen? We're actually starting to see CPI taking out the volatiles. We're actually starting to see that drop. Core, we're actually starting to see that drop and start to turn down. And I think that's really important because when they took out the really volatile items here, you actually went down versus what you have going on here. And that's very important for people to get. I think this is where the devil's in the details. And I think this is why some people are leaning to the fact that, hey, this PPI, these import price numbers, they're down. Like, for example, if you're importing food and energy, just say you're importing your fruits, your food, your energy, your vegetables, your fuel, all of that. Let's just say that you are, and you start seeing those numbers drop and import prices are dropping. Well, wouldn't that lead you to believe that this is going to drop? And then wouldn't that lead to the fact that you might think that PCE is going to be lighter? So this might explain why Goldman and JP Morgan are coming out and saying what they are. Now, this is where it got really interesting, to me at least. And this is just ripped from a headline, and we'll just go from there. But I took it out of a research report. But the important thing about it is we're only going to focus on a couple numbers. And let me just walk you through what we're going to focus on. Here's global. Here's GDP growth. We can debate this, not debate this. If I look at CPI inflation globally, what are they saying? That it's going to come down. So global is going to come down. Global X, the US, is going to come down. All right, so then if you go through the G6 nations, which are just right down here, and we just go, and what are they saying? Here we are on CPI. Now, why do you care about this? Well, like from a trading perspective, why do you care about this? I'm going to show you in a second here. But I want to just be clear about this. If the US had an area where they were really concerned, and we spiked the way that we did, why didn't they raise any of these numbers? These are all after the fact. Why wouldn't you take inflation up? Why would you take PCE down? And the only reason that you could possibly come up with is that they're thinking that this peaked. Other than that, there's no justification for leaving these numbers the same, or as they did with PCE, taking them down. And this is really important for people that are swinging trades or long-term traders because they're not understanding what happened. Let me show you. Now, for our purposes, I just want to just review where I'm going with this and why I think this is so. If we take a look at back in here and we look at these levels, you can see that you have the lower low right in here from that June 22 to here. And most people are going to say, well, what does this have to do with anything? What you're always doing as an investor is you're always looking at past performance and trying to see how he acted and then go from there. So if we really look at what happened right here, what we will find is that that was peak CPI. Then we had a little undercut and then we went from there. Now, if we did the simplest of things and just take RSI for a second, you're going to see that you lied right in here and that you had a nice turn or divergence. So you can send this to anybody whenever someone says RSI doesn't work. You just send them this chart. You don't have to say a word. If you followed me on Twitter, you remember when I put this out there, I literally said, no one's going to ring a bell. And you never know how this is going to play out, but ding, dang. So now you look at this going, okay, well, what does this have to do with anything? Now watch this when we get into this on an hourly basis. And I think that this is where it gets super interesting. At least to me, it does. So you can see your little divergence right there where you're taking out that lower low, and we can see all these levels here. And I always look at this stuff as a range, but you can see how that's playing out right in here. And just for everyone's education, you can see this, and this is actually directly from the Federal Reserve. But what you can see is like this is their target, right? And then you can see how we're going. But you can see where we peaked, peak inflation, and then what happens to the market. And then of course you have all the stuff. But what's important about this is, yeah, you peaked and you started to roll. And then if you were looking at this side of the chart, did it look like you were peaking? No, not until when? Not until you peaked. All right. Now, I am a huge user of RSI to trade and also to invest. And I have found over the years that it's extremely helpful. It doesn't mean that you find it helpful, and that's okay. But if you take a look at these levels and you see how this is playing out, you will start seeing these everywhere. And this is from 2025. And if somebody was using this effectively, they might look at this and go, oh, this is an area of interest. I should probably watch how we do there, instead of saying, you know, the sky's falling, right? And the same thing could be said here if you start looking at these little levels and you're watching how this is playing out and going, oh my gosh, the sky's falling. Instead of that, you might just say, oh, that's interesting. Now, even these little ones you could look at and make those arguments, right? You could to an extent, but let's not do that. Let's just take a look at these bigger moves that are obviously and clearly putting in some kind of support and resistance level. And then what you could always do with it is just zoom out a little bit more and go, well, is there something really there? Or is he just drawing a couple lines? And the bottom line is I'm actually doing both, right? So it is really there, and I am drawing a couple lines. And if you knew how to use this, you'd be looking at this and going, oh, well, that makes sense. That's why people bought down here. They watch the gap fill, and people will say, well, why did that gap fill hold versus this one? What you're doing is you're stacking wins. So like the more things that you could stack that would tell you that this gap fill will hold, the better, right? That just makes sense, doesn't it? I mean, it's not rocket science that we held the gap fill from the election, but what's important about that is maybe having that extra indicator tell you this might give you the confidence to actually buy here, which some people did. Specifically, we did this in the community. But here's the point. You can look at the macro, you can look at the fundamentals, and you can look at the technicals all you want. Unless you start putting the pieces together, it doesn't make sense. You can have a crust and you can have apples. You got to put it all together to get a pie, right? And then it's just how good you are as a baker. You get it. Anyway, so I don't know. I like that analogy, so now I'm hungry. But if you look at how this is playing out, people say, well, that's not the same thing. You're at the top of a chart versus the bottom of a chart. And my argument to that is, are you? Are you at the top of a chart? You know that that's the top. You don't know that's the top. You think that's the top, right? You don't know where we're going. And I think that's what people need to get their noodle around. Like, you're just assuming that we're at the top of a chart. But if you start connecting all these dots and you say, well, and this is what I want you to wrap your head around. And that was the whole point of doing all of this, to get to its final conclusion. Like, here's the arc. You don't know what's going to happen, and you might have peaked on CPI. And the argument is, how can you say that? And I'm looking at everybody dropping their PCE levels. So why are you dropping your PCE levels if inflation's going to spike and rear its angry head again? And why am I getting similar signals here back to trend lines that I've gotten back here that signified the bottom? Right? So I don't know that this is a bottom. I also don't know that it's a top. So you need to look at this and say, this is what's happening. And the last time that inflation peaked and reversed, what happened? This is what happened. And I think that you're going to be strongly remiss in not getting that. And there's a lot of things that can get inflation down, such as the Russian-Ukraine war ending and the market flooding with oil. There's a lot of things, but take a look at this. And I just want to reiterate that point as we go to the next stage here, and I draw this trend line just so you can get it. But what people are not truly getting from this is that, do you really think if Russia-Ukraine ends, and it will end, do people really think that they're not going to flood the market with money? Like, all that money that wasn't in the SWIFT system, people actually think that's not going to come back in? I have a really hard time believing that. So I really think that people need to think about that. I think it's one of the reasons why you see these names moving. What I tend to do at these levels, and I find it extremely helpful, is you look at them as a fork. People will say, oh, well, that's the trend line and I have to get there. I would say there's degrees to trend line. So in other words, as you pull back, you're going to get to one level. As you pull to another, you're going to get to another. The degree in which you drop to that trend line is predicated upon the news and the information, right? That's really what happens. That's why people will have certain support levels that work, and then other people will have other trend lines that work. For me, looking at it as a fork really tells me more of a story than anything else. This is also why you'll see a lot of people, when they look at charts, they won't use just one moving average. What they'll do is they'll use several at the same time. So I'll show you what I mean by this. So if I pop in, let's say the 12 here, and we'll make this white so that you can actually see this. And then we pop in the 22, the 55, and the 200. And then we go and take a look at something like this, and we do it on a weekly, and you're going to get a look of it like that, right? And so what they're really looking for is they're looking for the trajectory of it. So it's the same soup reheated, just with different ingredients, but it's still soup. Right? No matter how you look at it. Man, I'm getting hungry. So think about it that way. Same thing with channels. When you draw these channels, it's the same thing. It's why support and resistance work, etc. All right, let's go. Now, where does this all lead? It leads to understanding that the U.S. is not going to be the only game in town. And this is not a bad thing. Global prosperity is not a bad thing. I know there are a lot of people that are looking at this going, oh, it's just going to be America that's just going to benefit greatly from what's going on. If inflation comes in, it's far from it. If you take a look at some of these moves, and I think that this is really important to get, if you look right in here, from November 6th on, what has transpired with the DAX is nothing more than incredible. It's probably one of the greatest moves it's had in the shortest period of time. And if you really just go and take a look at this, you can see it, where you really haven't gone anywhere for about, oh, I don't know, maybe about 4 years. And then all of a sudden you started breaking out into here. And then you kind of got it. Okay, they're trying to figure it out a little bit. Germany's getting a little bit better. And then it just explodes out of nowhere. Why is that? And you have to look at where all this is going. So I don't want to spend a lot of time on Russia-Ukraine. We're going to do it in another video as it comes out. But I do think you'd be remiss in not understanding how this is playing out, and that the goal here is to end this. And no one's going to benefit more from ending this than anyone that is close to Russia, because that money will flow out of Russia and into European equities or European hard assets or US hard assets. So you're going to see the DAX continue to rise like that. And then you'd start looking at names like this, like SAP, which has obviously and very clearly been on a absolute just run. Now, the reason for this, to me, I believe it's more AI related and people utilizing their skills to figure out and go, what is AI? How do I use it? Please, God, help me in my company so I can keep my job. I mean, I do really believe that. I think that's one of the reasons why you're watching names like Accenture, like these names are all setting up to break out. You can just see it all over the place, like CTSH, anything like that, where they're coming out with these technology solutions. I truly believe that these guys are like, hey, do you have something that could implement that makes me look cool and hip with the young people? And they're like, yes, we do. And then they're selling services. That's one of the reasons you're seeing this. The other side of this is you have to think about it from this perspective. When you had Berlin, and I know a lot of people don't know that Berlin was split at one time, but when you had something like this play out, what happened to Eastern Europe? And how did that go for Eastern Europe? How much prosperity came into Eastern Europe? So if you're not thinking about where this is going and why, and it's tied together, you need to get that if Russia gets back into SWIFT, it's not going to increase just demand, it's going to increase supply drastically. So things like when you start thinking about the dots that you would connect, you would look at the tankers and go, well, why are the tankers dropping? Like, why wouldn't the tankers go up if you're going to get more oil? Because their pricing power is going to fall off a cliff. So all of a sudden, why would their pricing power fall off a cliff? Because Russia's got more boats docked that they can't go anywhere. I mean, they can only run so much oil through India and pretend it's not them, right? There's only so much they could do there. So then if you just connect these dots, stay with me. But if you connect them and go, okay, well, what about crude oil? Well, wouldn't crude just absolutely drop? I think it does drop. I think it drops pretty hard. Matter of fact, if you were to look at the top 3 firms out there that put out any kind of data, all 3 of them are saying that the energy sector is the only one that's going to lose earnings year over year. Now, usually that means that if everybody agrees, it usually means they're wrong and there'll be a reason that it'll go up and we'll figure that one out later. It's like when everybody thought we were going to lose every regional bank. I don't know if you guys remember that or not. We were going to lose every regional bank. We were all going to be in line to get our money out. It was the single greatest opportunity ever to buy regional banks, right? Or remember when we were going to lose every single piece of commercial real estate? You guys remember these? And then all of a sudden it just created the single greatest opportunity probably in a generation to actually be able to go out there and buy New York real estate. Some people just don't really get this stuff and how it actually works. But I mean, there you are at 22. And you guys will remember this stuff where all of a sudden Japan came in and decided they were going to buy 245 Park. What the heck does this have to do with energy? It has to do with the same thing. Just because someone says something doesn't mean it's true, but you have to start connecting the dots. So the dots that I have connected are, I think crude drops. I think crude drops pretty hard because I think that OPEC and the way that Russia are going to go, I think that we're going to drop oil prices down. I think that OPEC is going to do that, and I think Russia is going to flood the market because now they're going to have access. And at least you're going to see some movement down, and that is going to increase GDP, which is going to spur productivity. Where does all this go? It leads towards what I think is the obvious. It leads towards manufacturing increasing. And then people will say, well, if manufacturing increase, doesn't that have anything to do with inflation? Isn't that bad? No, it's only bad if there's only so much supply. If you increase supply and supply outstrips demand, pricings go down. Why do you think import prices dropped if you go back and take a look at this? But in front of you is the United States Purchasing Managers Index on the manufacturing side. And I just want to show you this because it happened last month and no one's really talking about this, but we are now. If you take a look at this, and you watch how this is playing out, you're above at 50. So just so people understand the Purchasing Managers Index and how this stuff actually works, is that anything above 50 is expansion. Anything below 50 is contraction. 45, when you're at 45, it's almost like an ultimate rate cut. Anything above 55 is almost like an ultimate rate hike because you're overheated. That's what was crazy about this when Itchy was pretending that he didn't say it. It was just madness. There was never really any time in history where they didn't raise rates when you had a Purchasing Managers Index on the manufacturing side this high. Like literally never any time except Itchy time. Even here, Itchy decided to go out there and raise rates, and we know what happened. So when you see this, you have to understand that they are going to increase manufacturing. The only reason they're going to do that is because they see increased demand coming. So when you start connecting that, you're like, oh, well, that makes sense, right? All right, so if you get that and you understand Europe, then when you start seeing some of these other dots, let's go back this way and I'll connect them so that you can kind of get it. So then when you start connecting these other dots, you'll start looking at this stuff, it'll start making more sense. And you'll start saying like, well, why is Hermes breaking out? Why is Louis Vuitton constantly saying that earnings are bad, but the stock just cannot go down? Why does it keep bouncing, right? Or you start looking at European companies like Ferrari. Why are they breaking out all of a sudden? Because the amount of money that is going to come into the market from Russia and flood European goods. Like, if you remember when the Berlin Wall fell, people were like, this is not like the Berlin Wall. I got it, but we only have so many events. So if we look at it from that perspective, what happened there? Everybody went out and bought Jordache jeans. Everyone in Russia wanted to own Jordache jeans. What happens, there? I was more in the Calvaricis, but it is what it is, personal preference. So if you look at some of these names, they're breaking out. Well, why? Because people already know that when they get back into SWIFT, there is going to be a massive amount of money that is going to come into the market. A matter of fact, if people were smart, what they would be doing is looking at areas throughout Italy and other places where someone from Russia might go to start buying real estate, quite frankly, because that's what you're going to see happen. Because they're going to want to get their money out of there. And that's going to take you to the same thing. Like, well, why isn't that going to increase inflation? It's not going to increase inflation because supply is going to outstrip demand in certain areas. But demand for certain goods is just going to go up because of increased productivity. So the high-end luxury goods will go up. But it does make you wonder about when you look at something like gold, does that continue? I think it might because of the amount of money that's going to come out of Russia and look for a home. But I also think it explains why you're watching things like copper absolutely explode. Like, copper's not going up now because of what's happening now. Copper's going up because of what can happen. And right now you're kind of hit at that triple top level. I think you want to back test and go from there. What you don't want with copper is for it to come all the way back down, but you're holding in there. All right, hopefully this makes sense. You might want to watch parts of this a couple times. And I just want to go through like why you want to watch this or why you want to listen to this. I've been watching trends like this for years, like literally been doing this for 20, 25 years. And the trends are where I made the majority of my money doing this. I do the day trading, I do the swing trading, but when you find these trends and you tap into them, you don't really have to do anything else with them except follow the trend. Now, we can argue about technical analysis or fundamental analysis, but when it comes to looking at trends, I've been doing it a long time. It's actually how I learned. So I'm very comfortable and very confident when I see these trends develop. And that's what I'm trying to share. It was interesting. I was talking to somebody yesterday that I work with and like one-on-one. And what got me about it was this. It was the explanation that I am very good at identifying what names move. It's not understanding what names move. It's understanding the trends. So at the end of this video, I'm going to give you an example of this. About 3 weeks ago, I put out a private video. I'm going to link the private video at the end so that you can see how significant trends are. So if you're in the community, you've already seen the video, you don't have to rewatch it. But I put out this private video and I put it out the night that Microsoft had their earnings and Meta had their earnings. And the reason that I did, because it was game over. And a lot of people aren't even understanding why Meta's going up. They don't even have a clue why Meta is actually just crushing everything else. And once you understand the trend, and I'm just going to save everybody a lot of time. It's a 20-minute video. Meta won. It's over. Like it's absolutely 100% over. They won. It's not even up for debate. You can comment on it if you want. I don't really care. It's over. So when you look at these charts, so when I put this video out, and it's a private video, but I will link it at the end because it's been through. But from here over, from that date on, I think the difference between going long Meta and shorting Microsoft is like 23% in 3 weeks. And once you get the trend down and you understand where it's going, and for example, like with this, it's all about what Meta did and what they're doing and why Microsoft has just completely missed the ball. A matter of fact, if you go back to Microsoft's quarter, Microsoft's the only one that didn't increase CapEx out of all the big dogs. And there's a reason for that because they're just absolutely hosed. But I'll link the video at the end if you want to see the level of detail that I do get into with these kinds of trends. I think it's important for people to get the kind of detail that you have to put into that. And I don't mind sharing it at this point. But the purpose of understanding this is looking at these trends and seeing where they're going to go and where we're going to go next. And that's why I wanted to do this. Let's get to some ideas for next week. So we can start seeing just the simple trades like XLC. Obviously, that is continuing to break out. That's going to be your Metas, which we just went over. That's going to be your Netflixes that are out there. These names are just on absolute fire. The question does, Bo, does that start to lift Google or not? Maybe not. Maybe Google just stays down. They kind of have a problem right now, and it's obviously through search. Search results are dropping to single digits a little faster than people thought with all the Chat GPT stuff and some of the other things out there. So you want to look at that, but you might want to go through those names. Like, does Charter start to make sense? That's an XLC. I think it does to an extent. I think that some of the other areas that I would be looking at would be like the IGV, for example. If I was starting to look for newer swing trade ideas, and then you start seeing left shoulder, head, right shoulder on the technical side. And you remember, as we go through all this, it's the same thing where you're looking at the fundamentals. Let's look at the macro, and then you're looking at the fundamentals, and then you're going to look at the technicals, right? You're going to constantly look at this and understand where you are in the pecking order on the trade. And for me, looking at this, it's very clear what's happening here. So when you start to see this kind of stuff, does it start to break out? Well, it certainly looks like you're breaking out and setting up for increased productivity. It certainly seems that way to me, and so does it seem with the Purchasing Managers Index. So you could see why you would start needing some of these names, and that's going to take you into things like CRM, and we're coming out with earnings pretty soon, and some of these software names just look absolutely fantastic. If you take a look at cloud and start seeing how that's setting up and its inability to break, looks very different than the SOX that's still trying to hang in there. Even if you look at the equal weight SOX and you just see how it's still not going anywhere, but look at that compared to like the AI SOX, they're still not going anywhere. But if you start looking at the cloud names, they're all setting up, they broke out, and then they're consolidating again. I mean, that's all we've done here is break out, and then we've consolidated probably for about 3 weeks. This is exactly what you're looking for. So some of the guys are trading, guys in general sense, but are trading like Crowd, and they've done exceptionally well with this trade. I'm not in it, but you should be looking at the software names. I mean, it's pretty clear where all this is going. And if these AI bots are going to be cheaper than people think, then this is exactly where you want to put your time into. I mean, it just makes sense. You look at Crowd, you look at names like Snow that are continuing to push. Is Friday an issue because of that? Maybe, maybe not, but I do feel that way. You start looking at names like NVIDIA that are going to obviously come out with earnings. I just think it's pretty interesting to note that NVIDIA has not had one day, even though you've had lower lows, you've not had one day where buying the open and selling the close did not work. Like literally have not had a day since it broke down where you could have just bought the open and sold the close. Like every single day it's worked. And it's probably going to work until it doesn't. Probably Tuesday now that I said it. But I do think that's interesting. If you look at the AVGOs of the world, are they really breaking down? No, they're just going sideways. So when we start looking at this and going, well, where should the focus be? I think it's very clear what's going on when you start looking at names like Dash and anything that's an application. Like any application name is just ripping its head off right now. And I don't see any reason why that's going to stop. So that's really where I would be focused on, more the application. Some people are looking at names like GDDY. I don't know that that's where you want to go. Certainly not now. I don't really want to be trying to catch that falling knife. Do you look at something like Reddit? The DAUs are down, the daily active users. Do you really want to be there playing the one that missed on the daily active user side? Probably not. So I think you look at it that way. And the biggest tell for me on whether or not a sector is going to be hot is when you don't really do what you're supposed to do. And this was a trade that we did on Friday. But let me just show this real quick. I hate when I say things and then just don't show the timestamp. So for example, here's PAN. And then what I'm doing with it is I just started it. And what I'm really focused on is this area right in here. And I'm just watching it hit the 55. I use a 12, a 22, a 55. You should use what you're comfortable with. But I'm putting the trade in here. I'm watching it flip the open. And then it just stays right in here. So I'm looking at that level in the daily. And it was like 192.57 when we put it out. Timestamp there. And then what I'm doing is I'm just watching these key levels on the post and the pre. And when it gets to levels like this, I'm just trimming into it. And then really what I'm looking for is for it to make a decision, which it did. And then I'm just raising the stop up to those decision levels. So I hope that's helpful. But I would suggest that you do things like that. For example, when you look at these 55 levels, I could do a whole class on this. Maybe I should start doing more lives and taking questions. Because stuff like this with even like Reddit, this made so much sense to me on how this name acted. It just made so much sense. Let me just show you this. Like here's the 55, the 22, and then the 12. But if you look at like Reddit, like watch this after hours. Like this is just fascinating stuff. We had a guy in the room that absolutely slaughtered it with this trade, like just absolutely killed it. And what he did was he just bought like right off the 55 post market, and it just stopped right there. So like if you look at that level, watch, but wait, there's more. So if you watch that level and then you just kind of drill into it, you got right to it and you just bounced right into that support in the 55. So I use a 12, a 22, a 55. You should use what you're comfortable with. But where are we going with all this? Software is going to eat the world now because the applications, and I'll get into this next week. And that's why I always say you want to subscribe to this channel because of how we link everything. But what's really going on here is this. If we take a look at something like PANW, software's eating the world. And the thing about DeepSeek, what it showed more than anything, was that the computing power needed to do what they're doing is considerably less, which makes it more advantageous for these software companies. That is it.